Good afternoon. My name is Brian Mellum. I'm President and Chief Operating Officer of Toscana Capital Corporation in Calgary, which is part of the Sprott Toscana group of companies. Firstly, I'd like to thank you for being here this afternoon. There's probably a lot of better things you could be doing in this beautiful city of Vancouver. With me here today is one of my business partners and our Vice President, Dean Jensen. In the 30 minutes that we have been allocated, we're going to give you a quick overview of our business model at Sprott Toscana in order to give you an appreciation for the unique perspective it gives us on the oil and gas sector in Calgary. Following that, we will discuss some of the current trends in the North American oil and gas sector with a particular emphasis on how these trends are affecting the junior oil and gas sector in Western Canada. So with that, I'll turn the podium over to Dean Jensen.
Thanks, Brian. When we were on the way to here to Vancouver last night, I was kind of figuring this has got to be the first time a couple of soft rock oil and gas guys are presenting to a bunch of hard rock investors. Nevertheless, what we thought we'd do, as Brian mentioned, is give you an overview of the Sprott Toscana Merchant Group, which consists of 5 operating entities: Toscana Capital Corporation, Toscana Financial Income Trust, which is a private income trust, Toscana Energy Corporation, Toscana Energy Income Corporation, which is the public entity, and Maple Leaf Energy Income Fund. With respect to Toscana Capital, it was established by Brian and our other business partner, Joe Durante, back in 2003. And it's primarily an oil and gas mezzanine fund. We've done in excess of $370 million in transactions, consisting of about 100 investments or so. Toscana Capital is the manager of Toscana Financial Income Trust, which, as I'd mentioned, is a private income trust that was formed in July 2006. Toscana Capital, the management company, was acquired by Sprott, Inc. in July of 2012, along with Toscana Energy Corporation at that time. Brian and Joe and I, we continue to manage the capital in the respective funds, and Sprott just acquired the management companies. In terms of the mezzanine fund, typically the deals that we're looking for are secured. Pardon me. The transactions we're doing are typically 6 to 24 months in length. They're all secured by oil and gas reserves. The targeted rate of return, that goes anywhere from 12 to 20% annualized, depending on the risk. Secured loans, first and second charge debenture. The criteria for lending against reserves is we typically won't exceed 75% of the total proven reserve value, which is confirmed by independent evaluations as well as our own internal engineer. Typically, we're repaid from conventional lenders or equity or asset sales, if the case we're bridging those. Our distributions are paid quarterly to our unit holders. It's our RSP eligible investment, and while not public, we do have a pretty active gray market. If we could have them later, that would be fine. Great, thanks. A bunch of old hairs running the funds. Our partner Joe Durante, who in fact founded Toscana with Brian back in 2003. Joe has a lot of operating experience. He's founded several oil and gas companies, worked with a big investment manager in Calgary, and was a former chairman and is actually president and CEO of Toscana Energy Corporation. Brian, banking background as well, as we all do. We're all ex-National Bank oil and gas managers, where we ran the junior oil and gas portfolio there for a number of years. As I said, we're all old and gray, and it served us well over the last 10 years. In terms of the Toscana Financial Income Trust itself, As I mentioned, the trust was founded in July 1st, 2006. We were previously funded under a limited partnership structure. Found that was too cumbersome to manage, and in 2006 we converted to a private income trust. Gave us access to registered funds, and at that, when we formed the trust at that time, we raised $28 million. The track record of the trust since 2006 has been pretty consistent. As I said, on a risk, the rate of returns from anywhere from 10 to 13%. And the last year's return at 10.1% was generated at a time when we had 50% of our fund in cash. So pretty good returns, notwithstanding the cash drag that we experienced. Interesting to note is the risk-adjusted returns is probably going to add a couple hundred basis points to those returns, given that all the transactions that we undertake are secured. The flagship of Toscana, the Sprott Toscana companies, is Toscana Energy Income Corporation. And this is the publicly listed traded company that trades on the venture exchange under TEI. And TEI was formed in October of 2010, really to meet the demand of our existing Toscana Financial Income Trust unit holders. It targets investments operating and non-operating direct working interest in oil and gas reserves, royalty interests, and unitized interests. We're targeting a 60-40 split oil to natural gas and reserve life index greater than 8 years. The relationships, how we're going about targeting relationships is we've all been in the oil and gas industry in Calgary for in excess of 30 years. We've leveraged those relationships to build Toscana Energy. And what we've found is over the last few years, with a number of intermediates and majors shedding assets to redeploy their capital, it's given us a good opportunity to get in and buy assets at a discount to NAV. Toscana Energy Income Corporation also manages the Maple Leaf Energy Income Fund, which acquires a pool of selected non-operated direct working interest assets in oil and gas production. It has monthly cash distributions on completion of certain drilling programs. There's a potential for capital appreciation at the fund maturity, and its tax deductions equal to 100% investments based on the CDE declining balance. Management of Toscana Energy is Joe Durante, as I'd mentioned, his background. Glenn Tanaka, 36 years oil and gas experience, previously with UTS and Pan-Canadian Resources. We've got Shauna Shakilo as a Chief Operating Officer, formerly with KPMG. The board of Toscana Energy Corporation consists of some very experienced oil and gas and finance individuals, some of them who you may know. Don Copeland has sat on numerous oil and gas boards as well as service companies. And he also currently sits on Sprott Resource Lending Corporation's board. Joe Durante, we've gone through his background. Tom Budd, I don't know if many of you know Tom, he was former vice chair of GMP Securities. Marty Hislop, previously founder of APF Energy Trust, which was sold to Starpoint Energy, which later became Crescent Point. Marty serves on a number of different boards. Peter Kasiba, presently a director of Yoho, and was a previous advisor to JF Mackey. And then John Festival, who was president and CEO of BlackRock Ventures and currently president and CEO of Black Pearl. This gives a bit of a timeline with respect to Toscana Energy's corporation growth. We initially founded Toscana Energy in April 2010 by way of a $5 million private placement. Management and insiders probably put up 60% of the capital to found the company or to start the company. And the timeline goes through pretty active through December 11. We did a $15 million brokered financing in April 2011. Used that capital to acquire additional oil and gas reserves. Continued through last year where the company was extremely active and did an amalgamation with a public co-Semmar, which allowed the company to go public last October. We recently completed the acquisition of the WCSB funds, and last week it was announced that the company did a $20 million bought convertible deb, which will provide balance sheet strength for additional acquisitions going forward. Part of the success of Toscana has been its value-added acquisition strategy. It's not essentially a buy and hold strategy that the company's adopted. As evidenced by this slide, you can see that we acquired Joffre back in 2010 for a price of $8.6 million, and turned that around, sold that earlier in the year for $26.73 for a 211% return. So some of the other acquisitions that have been very accretive as well, West Central Alberta acquired at $17 and turned around and selling it for $31. So a lot of companies, particularly the dividend-paying models, are looking at the buy and hold strategy, and we just feel if there's an opportunity to grow the company through capital acquisition and redeploy that capital to other opportunities where we can buy additional assets at a discount, we'll do that. This slide shows the production growth since the company's inception back in 2010. You're not seeing that type of graph very often anymore in the junior sector. And that's really being driven by a sound balance sheet, which has allowed the company to get in there and bid assets at very favorable prices. This essentially is a slide reflecting the reserve life of the company, and what I bring your attention to is the proved producing reserve life line there. Being a dividend-paying corporation, you want to have dividend sustainability. At the present time, the company's only paying out about 40% of its cash flow in dividends. So that, coupled with the fact that we've got probably a 10-plus year reserve life, ensures that those dividends are going to be paid and are definitely sustainable. A little bit about the reserve value and capitalization of the company. Reserves were valued at $136 million at the December 31st, 2012, based on, what was the price deck, probably about $350 and $85 a barrel of crude. Company at year-end had $41 million in debt. Common shares outstanding at the time were approximately $5 million, and the net asset value per share was $19.21. The company currently trades in the $15 range. It's very thinly traded and effectively is trading off yield at the present time at about 10-11%. A little reserve information. Shows the difference in reserve adds between 2011 and 2012. Certainly, reserves have been added. We haven't had much of a bump in the net asset value, predominantly, or the reason why being is the price of oil and natural gas at year-end. What I do bring your attention to is the F&D costs and the recycle ratios. They are heading in a very positive trend. 10.28 and $1.89 is probably top quartile for F&D and recycle. Dividends paid, very consistent since the last quarter of 2011, about 40.5 cents per quarter. On the preferreds, they were consolidated with the common in the first quarter of this year. And as I'd mentioned before, about 40% of the cash flow is being paid out to cover the dividends. Capitalization, said 3.2 million shares, 45 million. Long-term debt at year-end, 29 million on an authorized line of about 45. With the recent financing, that's going to knock the line down to probably outstanding debt of about 30 million on a $55 million line. So the key benefits of Toscana Energy Income Corporation: proven management, fully aligned with the shareholders. The management and insiders currently own approximately 10% of the outstanding shares. It's the dividends are supported by a long life mature base. Security of dividends is through an active hedging program, or it's ongoing hedging to ensure no downside cash flow risk. It's tax advantage through the dividend structure. And a little different than some of the other companies, the dividend-paying corporations, is compensation is driven off a BOE basis at 225, plus third-party costs, audit, legal, etc., are covered by the fund. There's no dilution to the securities, as management is incentivized through a 2% GOR. So we're fully aligned with the investors. We've got a lot of skin in the game, and we think that's very attractive to our existing shareholders. So with that, I'll turn it back to Brian.
Thanks, Dean, and thanks for everyone's patience sitting through the Toscana sales pitch. Now, hopefully, I'm going to talk about a little bit more fun stuff, try and give a little bit of an overview of the oil and gas sector, kind of where we're sitting today and what opportunities that might create for investors. So we're dealing, of course, with two different commodities here, with oil and with natural gas. And probably one of the biggest trends over the last couple of years has been the significant decline in the price of natural gas. We hit 10-year lows in the price of natural gas in the spring of 2012, which has forced many companies in the sector to switch their focus to oil and natural gas liquids because there's better prices there. So we're very much a natural gas focused basin in Western Canada. Going back to 2009, the average junior oil and gas company had 75% of their production from natural gas and only 25% from oil. But because of the decline in prices, that has now switched to approximately 44% weighting to natural gas for the latest period of time that we had, which was records for, which was Q3 of 2012. So they're down to 44% natural gas, with the remainder being oil and liquids. So what we've seen is that a lot of the natural gas weighted juniors have been left with very bloated balance sheets. Most of them have had assets up for sale, but it's been a very poor market to try and sell assets due to the depressed prices and a lack of buyers. Now, fortunately, we've seen a bit of a recovery in the natural gas price over the last 3 or 4 months, in particular due to a cold spring in North America in March and April. So we've seen the prices jump up from the $2 range to the kind of $3.50 range for AECO at this point in time. So while it's been a significant improvement, most of the pure dry gas producers, i.e. they don't have liquids in their gas stream, they're still barely profitable at these levels. So one thing that I would point out is, although we've had a pretty significant recovery as well, the general consensus is that we'll probably see a cap of $5 or so on MCF on prices for the medium term, due to the large amount of shale deposits, particularly in the U.S., that can be brought on economically when you get to $4 plus. A couple other key things I'd point out is we do have world-class shale gas reserves in BC and Alberta, which estimated at 1,200 TCF of gas in place. This should lead to to a significant development of LNG ultimately on the BC coast, we expect. So while that gas is currently stranded at these prices, as the LNG facilities start to develop, we should start to see prices come back up and make those reserves very economic. I would say, you know, we're primarily focused on the junior oil and gas sector at Toscana. One thing to note is the LNG market is best suited to the very large players, the likes of Shell, ExxonMobil, British Gas, et cetera, that'll come in and take over that market for the most part and have already started to. But the race to develop the LNG facilities will likely result in continued M&A activity for the international players that are looking for feedstock for the gas. So there's just a bit of a summary of what gas prices have done. On the left-hand side, this is also talking a little bit about the M&A market. On the left-hand side, in the red, you'll see the price of natural gas, what it's done over the last 5 years. The red line shows what gas is sold for in the marketplace over the last 5 years. So back when gas was $8 or so an MCF, gas in the ground, based on the right-hand column there, was selling for about $2.50 an MCF in the ground. Today, with gas prices down in that $3 range, gas is selling for about 50 cents an MCF in the ground, which, as I said before, makes it very difficult for these junior companies to improve their balance sheet by selling some of their existing gas. So switching now to the oil market, everybody's talking about you know, the success of the shale plays and the turnaround in production, particularly in the U.S., because of the same kind of success with horizontal drilling and multi-stage fracking on the oil side. We've seen a significant increase in U.S. oil production, you know, picking up from a low in 2008 of 4.95 million barrels a day to 6.2 million barrels a day, roughly, in early 2013. Now, while that is significant, looking at a longer-term chart, you can see that it's really just a blip versus where production peaked at approximately 10 million barrels a day for annual U.S. field production. So the U.S. Energy Information Administration estimates that U.S. field production actually reached 7.1 million cubic feet a day in Q1 of 2013 and will increase to 8.5 million barrels a day by Q4 of 2014. And again, while that is significant, I found this next chart rather interesting. On the red line there, you have U.S. crude oil consumption, and you can see that there's still a significant shortfall when you look at U.S. production versus U.S. consumption. So we're still a long ways from U.S. energy independence. But on the next slide, you'll see from a North American perspective, the Canadian oil production is going to be a significant factor. If you look at it on a North American basis, we could get close to North American energy independence. So what we have there in the red line is actual numbers up until 2010, and then a CAPP forecast for Canadian production from 2010 through to 2020. And although I don't have it on the slide here, Canada is currently a net exporter of approximately 1.5 million barrels, with the remainder consumed within Canada. The actual way it works is that Canada exports 2.3 million barrels a day and imports about 800,000 barrels a day generally on the east coast of Canada. So one of the movements is to try and get a pipeline to the east coast so that we're less dependent upon foreign imports and we can use more of our own production here. One other interesting slide when you look at kind of North American production is the significant drop-off in imports from Mexico into the U.S., and at the same time the U.S. is exporting more oil to Mexico. So although you've seen an increase in U.S. production, That's somewhat offset by lower production from Mexico and higher imports, or rather exports to Mexico. So just again, some of the major trends. You know, surging U.S. and Canadian oil production and pipeline constraints have led to very wide differentials on the price that Canadian producers get for their oil versus what the U.S. producers do. So basically, the oil has become landlocked here, and that's why there's such a big push for Keystone XL and possibly for Northern Gateway as well. What's happened is the industry is increasingly using rail to get their product to market. There is still big demand from the U.S. Gulf Coast refineries for the quality of crude that we produce in Western Canada. So you know, we'll continue to probably see rail making up a lot of the difference, with 200,000 barrels a day expected by year-end in Canada being on rail shipments, and up to 1.2 million barrels a day in the U.S. We've seen a little bit of an improvement in those differentials over the last few months as we've started to have the Seaway pipeline, which has been reversed and starting to eliminate some of the landlocked supply in central U.S., and also with the increase in the rail shipments. But again, you know, we're still looking at until such time as we have increased pipeline capacity to get the oil out of the country, Canadian producers will be subject to often very wide differentials versus the U.S. product. I thought I'd just cover a little bit on how all of these different trends have affected the merger and acquisition market. You'll see there that that we've got a very depressed oil and gas acquisition market currently in Western Canada. In the first quarter of 2013, there was only one corporate transaction done. That was Whitecap's acquisition of Invicta. So that's the lowest number of corporate deals since 1992. Just a couple of other things I'd point out there. The large number for corporate deals in 2012, 32 billion of the 40 billion in corporate deals was from 3 transactions. That was Nexen, Progress, and Celtic. And also the large number in 2009, 70% of that dollar amount of roughly 40 billion was the Suncor Petro-Canada deal. And then similar market on the equity financing side. You know, significant decrease in the amount of financings being done because of the depressed natural gas prices and the wide differentials on the oil side. We're down to $1 billion of new equity in Q1 versus about $10 billion for the entire year last year. So if you annualize the Q1 number, we'd be down about 60% in terms of equity financings. And interesting to note that 60% of the $1 billion raised in Q1 was for 3 firms. That was Tourmaline, Kelt, and Corex. So what's the outlook for the sector, particularly on the M&A side? You know, we expect it to continue to be a buyer's market. You know, very depressed numbers, as I've said. We'll probably continue to see a number of companies and properties up for sale because of those bloated balance sheets. And if vendors do want to sell, they've got to be prepared to accept a realistic price. And again, this is just kind of a summary of why it's been a buyer's market: the depressed natural gas prices, the oil differentials, and you know, another factor has been government intervention in the industry. You know, first with the change to the royalty trust structures back in 2006, then the Alberta Royalty Review in 2007, and most recently the changes to the Investment Canada Act and its effect on state-owned enterprises investing in Canada. So again, this is just kind of a summary of what we're seeing. Hard dollars are certainly very hard to find for the junior oil and gas producers, and so we've got continued high debt levels. and a need for companies to sell properties to improve their balance sheets. So, the good, the bad, and the ugly, as we call it. You know, one of the effects is the number of junior TSX and TSX Ventures companies have declined substantially from 87 back in 2005, and this would be companies of 10,000 barrels a day or less, from 87 back in 2005 to 47 in Q3 of 2012. M&A activity is at a cyclical low. Capital market appetite continues to be very selective, and juniors are divesting of their assets to improve their balance sheets. So looking ahead, one thing about this sector is there's always opportunities. What I would say is low-cost producers, including those with a lower cost of capital, have a definite advantage. We don't know when the sector will turn, but it always does. Any questions? Yes?
On an earlier slide, slide 1 or 2, you had the term gray market.
Yeah. So the question is, what did we mean by the term gray market on an earlier slide? Basically, as Dean mentioned, Toscana Financial Income Trust is a private trust. The units do not trade, but for our unit holders, we've been around for about 10 years, and there's periods of time when some of the unit holders want liquidity, so we try to attempt to match buyers and sellers. So if there is someone new that wants to come in, we'll put them in touch with the seller to try and get a deal done. Yeah, go ahead. You can come up to the mic if you want.
Hugh McLean of Grand Junction, Colorado. 2 questions. One is, how can retail U.S.-based investors participate in this? Is this Toscana Energy, is that a tradable entity?
Yeah, it is. It's listed on the TSX Ventures exchange. And so if you've got a broker that deals with Canadian firms, they should certainly be able to do that. Yeah.
And from your perspective, what do you think the possibility that the shale gas revolution in the U.S. will crash, courtesy of the Environmental Protection Agency?
That's a tough question. You know, certainly we've seen some of the environmental movement push back against the fracking fluids that are used. You know, I think the industry has tried to work hard to you know, work with different groups and explain exactly what kind of products they're using in that. You know, it's such a growth industry and such a huge amount of employment resulting from it. You know, there might be some states, particularly where the oil field or the gas field is closer to the surface, and you have to be concerned about those fluids getting into the surface water, where, you know, states like New York, where there likely will not be any development, but some of the other states, I think, you know, for example, in the Bakken in North Dakota, you know, there's such a large amount of employment from that I don't see that really changing. Any other questions? Yes. We do not. The question was, do we have a U.S. ticker symbol? No, we're only traded on the ventures. And as I said, you know, the symbol there is TEI. Anything else? Yes. Right. So the question is, there's a number of companies around that are fracking with propane, and how effective is that? That seems to be a little bit more of a relatively new technology. I can't pretend to know a lot about it. I know there's a company called Gas Frac that does exactly that. It's very expensive, and some of the concern is there higher chance of explosions or problems with that versus water or oil-based fracs. But yes, explosions underground, that's right. I'm not an expert in that, so I can't, you know, I just know what I've read basically, but it is I know that Husky's actually been using that quite a bit on a lot of their recent fracs, But I think it has specific applications where it works and others where it's probably a higher risk approach. That I couldn't say, but not as far as I know. Yes. So the question was, what's the expectation for Canadian companies for the approval of Keystone? That's a tough one. There's certainly, I don't think that anybody expected that the approval process would take as long as it has taken. There's been there's hundreds of thousands and millions of miles of pipeline throughout North America, and it is the safest way to get the product to market. So I think everybody in the business in Canada has been amazed at how long it's taken to get this across the goal line. So I think most people are reasonably comfortable that it's ultimately going to get approved, but it could take longer than expected. Anything else? Yes? On the income trust one, the first one, or Toscana Energy? Toscana Energy, it does have a lot of tax pools. I think that the projected tax horizon right now is about 7 years before they're taxable, but as long as they continue to buy properties, that adds to the tax pool base, so that could be stretched out. Sorry? Oh, dividends the question is how often are the dividends paid out on Toscana Energy? They're paid on a monthly basis. Anything else? Well, if not, thank you very much for, oh, sorry, there's one more question there. No, this would be very similar to the previous oil and gas royalty trust. The question is whether it's more like an ETF or like the previous royalty trust. And it's actually just it's a Canadian dividend-paying corporation. So for U.S. investors, you will face a dividend withholding tax, but otherwise it's taxed very attractively if you're a Canadian investor because it is dividend income. Yes? Sorry, I didn't hear that, sorry. Yes, the tax stream is treated as dividends, yes. Anything else? Okay, well, thank you very much again for coming out.